infinite velocity. What is it? Infinite banking plus velocity banking equals infinite velocity. Without further ado, let's get right to it. So to properly explain this, we have to first explain them separate and then we'll put it together. So to start, let's go ahead and discuss velocity banking. Velocity banking is a term used to describe a strategy of leveraging debt, usually a revolving line of credit, to speed up the payoff of another debt and or to offset the cost of another debt. The goal is to pay off all debt as fast as possible and then to reallocate the available debt towards income or revenue generating investments and or business activities. So that is the premise of velocity banking. Now, what are the fundamental basic principles of velocity banking? Number one, you've got to know your four numbers and you've got to list them out. So just knowing your numbers is not enough. You need to know what are your four numbers, which are your income, your expenses, your debt, and your cash flow. Starting with your income, take away your expenses, take away your monthly debt obligations. What's left is your cash flow. You then need to identify and eliminate inefficient or unnecessary spending. So by going through the process and the practice of listing out your four numbers and all the details, that is going to help you to identify if there is anywhere that is inefficient in spending. Where can you cut back? Where can you save money? Where can you reduce or consolidate expenses to minimize unnecessary spending and unnecessary cash flow loss? Just that by itself could potentially help you to find between 5 to 10% more cash flow just by taking an audit of yourself and going through the practice or the motions of listing out your four numbers. Then once you've done that, you have to understand your various accounts, their functionalities and rules. So you need to learn what you have and how do they work. Some people have credit cards that have promotions and they're not using those 0% promotions like they should be. Some people have rewards points and cashback points and they're not using them like you could. Perhaps you have other debt like school loans, car loans. You have to learn the rules of how those loans work. What are the interest rates? Are there early payoff benefits? Are there penalties if you pay early? So you have to take the time, go through every single one of your debts and learn the rules of those debts, not just the interest rate and the due date, but any other variables that come with that debt that you should know before you start formulating your strategy. And then you're going to plan your activity based on the current circumstances and prepare yourself to level up. So what that means is not everyone should start practicing velocity banking right away. Some people need to start with debt snowballing and just becoming a good steward of your resources and creating cash flow by eliminating some debts. If you don't have extra cash flow and your income is not strong enough, then velocity banking might not be even an option at the moment. Most likely, if you have bad debt, you probably also have bad credit. And if you have bad credit, well, to practice velocity banking, you need to get access to a line of credit, whether it's a first lien, second lien, HELOC, or a line of credit, a personal line of credit, or a business line of credit. It could also be a credit card, but it could also be a cash value line of credit or a whole life insurance policy loan. And so these are different ways that you can start practicing. But if you don't have access to those tools, you'll need to prepare yourself. You'll need to start with what you can start with in terms of being a good steward of your debt and becoming a good steward of your resources, paying things on time, start debt snowballing. And then as you start to progress, improve your credit, and potentially over a short amount of time, you can be in a position where you can qualify for the line of credit that you need to start practicing your velocity banking strategy. And once that time comes, you need to be ready to commit and take consistent action. You can't just do it a little bit here and there. You have to make a commitment. This is going to be a lifestyle adjustment for you so that you are going to be a good steward of every penny that comes into your personal economy. You'll be able to assign that dollar. Every dollar is going to be assigned a job. Whenever you don't assign a job to a dollar, that dollar will find a way to get spent. And before you know it, you have no idea how your money got spent. You don't know where your money's going. Why? Because you did not assign a job for that dollar. So if you have different buckets, a savings bucket, a giving bucket, an opportunity fund bucket, a vacation bucket, these are different places that you might assign a dollar to besides just paying for the debt or paying for expenses. And so this way your money has a purpose. It's not just floating where it gets spent and you don't even know where it went and how it got spent. So you want to be committed, and you want to take consistent action based on your plan. So what are the different strategies of velocity banking? Well, velocity banking can be done with a first or a second lien HELOC. The difference between the two is, first, a HELOC is a home equity line of credit. A second lien HELOC is what everyone's most familiar with. And what that is, it's a HELOC in the second position. So you have a mortgage, and as you make payments in your mortgage, the amount that you've paid is equity, and it sits in the mortgage, trapped in the walls of your house, meaning you cannot access that equity unless you refinance it into a first lien or a second lien, or you just refinance and cash out on the available equity. And so what you want to do is ideally get into a first lien HELOC, because the second lien HELOC, it's going to require more responsibility for you to manage that HELOC. You're going to have to make sure that it has all of the features that you need it to have so that you can move money from your personal savings or checking to the HELOC, and then from the HELOC back to the personal savings and checking. The strategy of velocity banking is leveraging that line of credit and putting your income into the line of credit to push down the average daily balance of that line of credit, and then you take a lump sum chunk of the line of credit to pay off other debts, whether it be your mortgage, school loans, student loans, car loan, credit cards, or other debt. And so by putting your income in that line of credit, it pushes the average daily balance down. So the actual interest calculation on that line of credit is calculated at a lower balance. Therefore, you pay less interest. And then as quickly as possible, you want to pay back the line of credit. If you can only get access to a second lien HELOC, then that means that your mortgage remains active. And as you continue to make payments on the mortgage, then that equity continues to be trapped in the property. And you're going to use the second lien HELOC to try to pay off that mortgage potentially. So there's going to be a lot of transferring back and forth between your personal checking or savings to the HELOC, and there's going to be a lot of timing requirements for you to get this right. If you can get a first lien HELOC, it's going to simplify everything, because now the balance of your mortgage becomes a balance on your HELOC, and the HELOC replaces the mortgage. So now as you make monthly payments on your HELOC, the HELOC itself is unlocking that equity, and you have access to it. You can literally make a $1,000 payment today, and tomorrow that $1,000 is available in the line of credit, and you can use it, you can spend it. So it's no longer trapped in the walls of the house. Plus, a first lien HELOC they're gonna attach a checking account to the HELOC, and that checking account is separate from the HELOC. So you no longer have to put your income in the HELOC. You let your income sit in the checking account, and what they do every day is called a sweep. At the end of the day, they check to see what is the balance of your checking account, and they treat that balance as if you paid that money into the balance of the HELOC. So whatever the actual balance is of your HELOC, your income just sitting in your checking account is pushing down that daily balance. And then, therefore, when the interest is calculated, it is calculated at a lower balance. Therefore, you pay a lower amount of interest. The interest rate is the same, but the amount it's being calculated on is lower. With a second lien HELOC, you have to move money back and forth to make this happen. With a first lien HELOC, you don't have to worry about that. You just let the money sit in the checking account. That's the beauty of a first lien HELOC. Okay. Plus, that first lien HELOC is going to unlock equity. And so that equity that gets unlocked is now accessible, and you can use that for either investments or to pay off more debt. So you're actively unlocking equity with every single payment. You can also practice velocity banking with either a personal line of credit or a business line of credit. Getting the right size line of credit is important for you to be able to practice the strategy. So depending on what debt you're trying to pay off, whether or not you can get a line of credit that's large enough on the personal line or in the business line is going to really determine if it's going to be useful to you to practice the strategy. But ultimately, as long as it's a simple interest daily calculation on an open-ended line of credit, you have the ability to leverage that again and again. And the same strategy of using a HELOC applies to the personal line of credit or a business line of credit that you can use to pay off personal debt, or you can use to pay off business debt. So you can practice velocity banking in your business if you have business debts, business loans, business credit cards, or any debt in the business name. With a business line of credit, you can practice velocity banking and transfer the debt to the business line and put all the income into that line to push down the daily balance. And the same principles apply. You can also use personal or business credit cards. Now, this would be more of a supplement to the strategy. You're not going to use personal or business credit cards to pay off your mortgage or to pay off huge debts, but you can use them to pay off smaller debts, or you can use them as a supplement to the strategy, especially if you can get access to 0% interest promotion credit cards, or you can get access to either cashback, rewards points, or travel points, and you're going to use those cards strategically to maximize the points. Now, the key with using the credit cards in your velocity banking strategy is to never let any interest get accrued on the credit card, which means that if I'm going to use a credit card as part of my velocity banking strategy, let's say I'm going to get 3% cash back on gas and groceries. Well, every time I go to the grocery store or every time I go to the gas station, I'm going to use that card to get that 3%. However, the same day, when I get home and I unload my groceries, before I do anything else, I'm going to log in and I'm going to make a payment equal to the amount that I just spent. So if I just spent $100 on gas, I'm going to pay that card immediately, same day. So it doesn't even have a chance to calculate the interest that night. I'm going to make that payment same day. But because I used that card at the gas station or in the grocery store, I'm going to get that rewards points. I'm going to get that cash back. And if I do that every single time I pump gas or I pay for groceries, I'm going to get a lot of rewards and cash back coming back to me, which is non-taxable income that you get from the rewards points and cash back of credit cards. So this becomes a supplement to my strategy, potentially another a stream of income which is tax-free. And with 0% promotions, I can leverage that during the promotional period to maybe do some balance transfers to offset other debts while I use my other line of credit to attack and pay those debts down even more aggressively. So I can combine a credit card strategy with my line of credit to maximize the efficiency, where I am not only paying down debt, but I'm offsetting debt, and I'm also getting income or interest back through these strategies. And then finally, we have velocity banking with infinite banking or whole life insurance, policy loans, and or lines of credit. So to explain that, let's go to the next section, which is infinite banking. What are the fundamental basic principles of infinite banking? You want to make sure you're using a whole life insurance policy, not an index universal life insurance policy. Number one. Number two, the whole life insurance carrier has to be a major mutual dividend paying insurance carrier. So not any whole life insurance, but a major mutual dividend paying insurance carrier. Number three, the split between the amount of premium that is allocated towards the cash value of the policy versus the amount that pays for the insurance policy itself has to be where we can maximize the cash value. The purpose of the policy is not to maximize the death benefit. It's to maximize the cash value. Now, it is wrapped up in an insurance policy with a death benefit, so there's a correlation between how much death benefit and how much cash value that you can save, and this is called your MEC, or it becomes a modified endowment contract, and that there's a relationship between your age, your income, and how much death benefit you have that will determine how much you can store in the cash value section of the policy. But in most cases, we can design these policies where you're going to be able to store anywhere between 70 to 90% of your premium in the cash value bucket. So on $100,000, that means between 70 to 90,000 is cash value stored in the policy that's going to grow with compounding interest guaranteed plus dividends. And if you borrow against the policy with certain carriers, it can be uninterrupted compound growth even if you borrow against it. That's what makes it so powerful, because now your dollar is doing 4 things at the same time. So now you have to understand the policy loans, and you have to understand how they work, and that there is interest on the policy loan. The maximum that they'll let you borrow against is 90% of the cash value. I recommend trying to keep your policy loans lower, no more than 65%. But if you had to go up to 80%, fine. If it's an emergency and you really need it, you can max it out at 90% of the cash value. If you're leveraging that money in an outside investment, which is giving you return on investment, then you have to take into consideration your opportunity cost and the fact that that money being leveraged from the policy is then giving you growth outside of the policy with uninterrupted compound interest growth inside the policy. So now your money is not sitting still, only doing one thing in your investment. It's doing 3 or 4 things. It's giving you a death benefit. It's protected from litigation. It's growing compound interest. And you're still using it in your investment, whether that's your business, whether that's paying off debt, whether that's the market, crypto, whatever you want to do. It's your money. You use it however you want. Now, with policy loans, the insurance carrier does not delegate a due date. So there's 2 things you always pay on your insurance policy. One is going to be the base premium so that your policy doesn't lapse. And 2, if you borrow money, you want to pay the interest minimum. Now, you definitely are going to pay back the policy loan, but you have flexibility with that. But you don't want to mess around with the interest because you don't want the interest to compound against you. So if you're borrowing at a lower amount and the growth in the policy is compounding and you're immediately paying the interest so it doesn't compound against you, you can create an arbitrage just there. If you're a business owner and you're borrowing the money to invest in other businesses, other investments, then you can make a loan from yourself personally to the business, and that loan can be paid back from the business to you personally before you pay it back to the policy. And you can use an intermediary, it's called PIGEON Loans, which I'll put in the link in the description. And by documenting that properly, that interest that your business paid you back on can become a business tax deduction. So that can also offset the interest rate on the policy loan, right? So we're winning here. Any way we look at it, it's a win. So what are some of the different strategies in infinite banking? Well, infinite banking can be used as an emergency fund. This is typically going to be at least 6 to 12 months of your income protected and saved in a secure vault inside of your life insurance policy with a guaranteed growth. And this is an emergency fund, a safe, secure place to save and store your money, not as an investment strategy, but as a saving strategy. So one way to use it is for your emergency fund. Another way to use it as an opportunity fund. So that may be double or triple the amount of your emergency fund that you've stored in the policy, so that if an opportunity presents itself, you have a safe and secure place to pull money from for that investment or for that opportunity. You can use it for debt consolidation, which is velocity banking. We can use it as a part of our velocity banking strategy, which we're going to talk about a little bit more. You can also use it for a college savings fund. Instead of the traditional college savings funds, which are taxable and are very restrictive, you have complete control, and the money is not taxed in the compounding growth of your insurance policy. You can use it for business funding, as we've discussed. You can use it for home improvement. You can use it for travel or vacation. You can use it for special events like weddings. You can use it for your retirement income as a supplement to your retirement income. And what are some of the benefits of infinite banking with whole life insurance? Well, number one, you're going to be getting guaranteed compound interest growth. Guaranteed compound interest growth. That's the key word, guaranteed. And the second key word is compounding interest. It's tax-free and or deferred growth. As long as your cash or money does not leave the policy, so it's growing in the policy, and if you borrow against it and pay it back, that growth in the policy is tax-free. At the end of your life, the policy is a whole life policy. So it's going to distribute a death benefit. That death benefit is going to be greater than the cash value. So in the end, the death benefit is what gets left behind to the next generation. And the death benefit is tax-free as well. So as long as your money stays inside the policy and it grows tax-free, and then you don't surrender the policy or surrender the cash value, that is the only time you'd be required to pay taxes, or if you MEC your policy, which means that you overfund it beyond the limitations of the required MEC of that particular policy. You'd have to either do that intentionally as part of your strategy because you're trying to get all the cash out and you'd rather just pay the taxes on it, and in some cases it makes sense to do that, especially in later years in retirement potentially. However, if you don't want to pay the taxes on it and you're looking to use the death benefit as your generational legacy in play, then you will not surrender the policy. You'll let the cash value stay in the policy and let it grow with the compounding interest, and that way there is no taxation, and then the death benefit will not be taxed as well. So that's tax-free, but if you surrender or you MEC, then that's where it will be it will be taxable. There is another time you can be taxed as well, which is if there was a balance on a policy loan and you didn't pay that balance in full before you died, then that policy loan would be settled by the death benefit. So if you had $1 million death benefit and a $10,000 policy loan that you never paid back, then that $10,000 would be taken out of your $1 million death benefit before it got dispersed. That $10,000 would then be a taxable event because it is being solved outside of the policy. Okay, so that is the third time where you can be taxed. And so unpaid policy loans that are settled by the death benefit could be taxed. If the policy MECs, it can be taxed, and or if you surrender the policy, it can be taxed. So these are 3 times that you are deferring. Otherwise, it is going to be tax-free. Your money is liquid and accessible via policy loans. So because of the policy loans, you have the ability to borrow against it. There are also third-party banks and lenders that will issue you a cash value line of credit, especially to your business, which sometimes is a wiser way to leverage because the rate on that could be lower. So you want to compare that depending on what you're trying to accomplish. But the bottom line is the money is accessible without penalties or fees. And so your money could be used while it's in the policy growing. You can still use it in whatever you want to do, whether it's paying off debt, buying a car, investing in your business or the market, or any strategies outside of your life insurance policy, which is really where you're going to grow your wealth, in your investments, in your business, not inside of the policy. The policy is a safe, secure place for you to park your cash, let it grow, compound interest with guarantees, and no taxation. That's why we do this. So we're giving our money more than one job, and then the generational legacy of a death benefit. You can never out-earn the amount of death benefit that you can purchase. Just say that to yourself a couple times. You can never out-earn the amount of death benefit that you can purchase. Finally, the policy is protected by the death benefit. So like I said earlier, if you don't pay off a loan, then the balance of that loan gets paid by the death benefit. That's what that means. It's also protected from litigation. So your cash value inside the policy in most states are protected from litigation. So in the event that you owe a debt, a creditor is coming after you, or you owe even a civil lawsuit, or even the government coming after your liquid assets inside of your life insurance policy, in most states, your money is protected and they cannot access your money in your life insurance policy. Currency standard protection. This is pretty cool. The fact is, because of it's a life insurance policy, if the standard of currency were to change to a gold standard or a crypto standard, then inside the policy, your money, which is right now the dollar, the US dollar or fiat, would then adjust to the current standard. You don't necessarily have that same protection with an FDIC insured bank. Unfortunately, your cash inside the bank is not protected from a currency standard adjustment or change. But inside your life insurance, it is. And it gives every dollar several jobs. So your dollar is not just doing one thing. Your dollar is doing several things. And if you combine that with the velocity banking, wow, you are supercharging every dollar and how it's being and giving that dollar multiple jobs. And then finally, living benefits. This is huge. Inside of most whole life insurance policies with these properly designed policies with major mutuals is something called an accelerated death benefit. The accelerated death benefit is an advance from the death benefit in your life in the event of chronic illness, terminal illness, or a specified medical condition. So this is amazing because potentially you would be able to get an advance from the death benefit, which is tax-free. You don't have to pay it back. And so if you become chronically ill, terminally ill, or unable to meet certain living conditions, you can request that. It's not a policy loan. It's not touching your cash value. These are living benefits in the life insurance policy that are truly an emergency fund outside of losing your income. If you become unable to care for yourself, you're able to tap into that. It could pay for any type of care that you need. It could pay for a doctor or some type of medicinal practice that is maybe not currently approved by the FDA. Let's say you needed to leave the country to get some type of treatment that's not covered by your health insurance. You can use that money for that. You can use that money to pay for someone to come and care for you or live with you. And so these are living benefits that you don't get just putting money in a savings account or in an investment instrument. But by using your whole life insurance policy properly as a strategic saving strategy, you'll be able to protect the money with all of the features we've explained, and you're going to get the living benefits if you need it, which by itself is worth it. It's so worth it if you need it. And so as far as your infinite banking strategy is concerned, if you do want to look at and see a design on your infinite banking, your whole life saving strategy, just go to wholelifesavingstrategy.com. You can schedule a free consultation, or you can submit your information to look at some illustrations and designs. So you just go to wholelifesavingstrategy.com. Now, if you understand everything I explained about the infinite banking policy design, the strategy of leveraging a whole life insurance policy, and if we can combine that with the velocity banking, then what we're able to do is further reduce the debt or reduce the interest rate on debts that might be a little higher than the line of credit would allow us to defeat through the policy loan. We're also going to gain the compound interest growth at the same time as we're paying down the debt. So if you combine velocity banking and infinite banking together as part of your strategy, along with a first lien HELOC and along with 0% credit cards and cashback and rewards points, you're going to be practicing the most efficient way of eliminating debt that you can potentially practice. You just have to know and understand the rules and the strategies so that you can play the game. Infinite velocity is the most efficient way of growing your money, protecting your money, paying off debt, and being a strategic leverager of your resources. If you enjoyed this video and if it was of value to you, please like, subscribe, and share. Please let YouTube know the value of this video so that more people will watch it and I can help more people understand these strategies. If you're looking for a coach, someone to help you with your velocity banking strategy, you can schedule a free consult with me and we can talk about coaching. If you'd like to look at an infinite banking whole life insurance saving strategy policy design, you can schedule a free call with me and we can put that together. If you want to combine strategies and become an infinite velocity practitioner, then I can help you put it together. Whether it's me or someone else, please look further into these strategies. Please do your diligence and become a good steward of your resources. Maximize every dollar. Get interest back wherever you can get interest back. Get rewards points and cash back whenever you can. Don't be afraid because it's not the standard protocol that everyone else is doing. These tools, these strategies are tried and proven and are in place for you if you have the right mind state, you're willing to be committed, you're willing to be disciplined, and you also have to be prepared sometimes to take a step back before you can take a step forward. With that said, please like, please subscribe, please share, and I look forward to speaking to you hopefully on a call sometime soon. Thank you again. God bless you and make it a great life.